Hi friends, good day. Today, let us try to understand about what is Darvas Box Theory and what are the rules in Darvas Box Theory and what are the fundamentals for choosing stocks for Darvas Theory. According to Scott Belsky, it is not about ideas, it is about making ideas happen. Before we go in,
Please subscribe for more videos. Click the bell icon for updates.
what is Darvas Box Theory? Darvas Box Theory is a trading strategy that was invented and developed by self-taught investor Nicolas Darvas, who used to target the stocks with pricing and volume as key indicators. Darvas has developed this theory in 1950s when he was traveling around the world in the form of a professional ballroom dancer. This particular trading technique or the theory involves buying into stocks that are trading at new highs, meaning the stocks that are trading at their highest price over the last 52 weeks, which is 12 months, and drawing a box around the recent highs and lows to establish an entry point and placement of the stop-loss order. These boxes are created by drawing a line along the recent highs and recent lows of the time period the trader is using. This theory isn't locked into a specific time period. Stocks are considered to be trading within a Darvas box when the price raises above the previous high but subsequently retracts to a price that is relatively close to the high. The Darvas box theory is regarded as a type of momentum theory or strategy. This theory is known to make use of the market momentum strategy along with technical analysis for determining when it is the right time to enter or exit the given market. Darvas box tend to be the plain indicators which are formed by drawing a line along with the highs and lows for making the box. Darvas believed that this theory worked best when it is applied to industries having the greatest potential to bring in investors as well as consumers with cutting-edge products. He also made it important to prefer companies that have stronger earnings over a period of time. The Darvas box method of trading is a combination of both technical analysis and fundamental analysis. In his journey of making 2 million, Darvas combined the two main fields of study carefully. Darvas focused on reaching a 52-week high or a low instead on volume. This makes the method of trading with Darvas box very unique. One of the main reasons Darvas was able to make so much of money so quickly is that he focused on the volume in an effort to gauge the momentum of the stock price. Many investors often end up holding stocks that give very less or meager returns and take a lot of time. With Darvas, it is the opposite. His method focused on stocks with momentum which tend to give higher returns in a short span of time. There are also risks with this style of trading. Momentum stocks can give you profits very quickly, but then they can also take away or erase your gainings just as quickly too. But Darvas was able to manage his risk by using technical analysis. Darvas theory reacts to the market trends. Using a reactive method means you, as a trader, react to the price action. You allow the price to do whatever it wants, and then based on what price does, you trade accordingly. This theory works by looking at the stocks that have a huge trading volume. He then analyzed these stocks and then bought the stocks when they rose to a 52-week high. In the Darvas box, the ceiling represents the 52-week high, and when the price retreated from the 52-week high, the resulting lows become the floor of the box. Following this, Nicolas bought when the price reacted back to the 52-week high and then broke above it. Alternatively, he would short when the stock fell from the lower end of the box, which indicates that price failed to break the 52 price week high and instead fell on the floor. Rules of Darvas box theory. First, to look for stocks and securities that are making a new 52-week high. Filter the stocks or securities and see which have retreated from the 52-week high for 3 consecutive days. The new 52-week high is at the top of the box. The breakout prior to reaching the 52-week high is the low. After the low is formed, it should not break that low for at least 3 consecutive days. Buy the breakout of the box, that is, if the stock breaks its recent formed 52-week high, and sell if the breakout is at the bottom of the box. Fundamentals for choosing stocks for Darvas theory. Darvas follows the principles of buy dear and sell dearer. Thus, as a filter, Darvas chose the stocks with minimum price of $30 or more. He did not pick cheap or more volatile stocks. We can interpret this as a setting limit on the stock's market capitalization. Back in the mid-1950s, Darvas had a preference for tech stocks. Technology stocks are known to be led by momentum and makes for great picks as they can give higher returns. Thus, you could use the same approach and pick similar technology stocks, but of course not the highly priced ones. After Darvas designed his box trading system, there is no record of anyone who managed to make such a fortune as Darvas did. This could partly be due to the fact that often traders do not give importance to the things they find irrelevant or simply ignore the basic rules that are outlined. Various examples shows that Darvas box theory indeed work, but for that to work, you need to put in a lot of effort into researching the stock and be patient when it comes to trading and managing risk. Well, thank you so much for watching. Please like this video and do share.